Hey folks, it's Tyson coming at you with another TCon video. This one is TCon on revenue, cost, and profit. So in this video, what will you learn? You'll understand types of profit, which mostly comes down to how you count costs, because accounting profit and economic profit differ insofar as they understand and calculate costs differently. So that's kind of your goal, and hopefully in the next few minutes you'll feel clear about that. One key assumption you want to keep in mind is that firms have one and only one goal, which is to maximize profit. And while these two have a slightly different value, the exact same thing that you do to maximize one is the same thing you do to maximize the other one. That's a subject for a different video, but to keep you out of suspense, that's produce the quantity where marginal cost equals marginal revenue. Okay, so let's get going. First thing to think about is revenue. And revenue is the money a firm takes in by selling its products. And you can calculate it as price times quantity or average revenue times quantity. Average revenue and price, pretty much always the same thing. When we think graphically, we can see total revenue as a box on a graph. All your boxes, almost all your boxes that you would think of for different kinds of costs or revenue, they're going to be as wide as the number of units the firm produces and as tall as that measurement of dollars per unit. In this case, average revenue, price per unit. That's dollars per unit, right? If I sell 20 t-shirts at $10 a t-shirt, then that would be $200 worth of total revenue, and that box would be 20 units wide and 10 units tall. Keep in mind here, revenue is one, but only one, of the components that we use to think about a firm's profit. Sometimes you'll be asked questions about maximizing revenue, and that's where you're thinking probably about elasticity and so forth, but really the goal most of the time is to think about maximizing profit, and that involves interaction between revenue and cost. What's nice about this? Everybody agrees, economists, accountants agree on how to calculate total revenue. It's price times quantity, and there's no argument about that. There are still challenges associated with revenue. I mentioned a second ago that sometimes you have to think about how elasticity works to help you understand how revenue could be maximized. But really, again, most of the time we're really focused on the firm's goal is to maximize profit. So that's a little bit about revenue. We'll come back to that picture with that green box of total revenue in just a moment. Let's change gears here and think about cost. Cost is what a firm sacrifices in order to make products. And we can think about costs in a bunch of different ways. Maybe they hire more workers as they're producing more output, and those cost for labor would be a variable cost. Maybe they have some mortgage payments or something they have to make on their factory no matter how many units they produce, and that would be a fixed cost because it's independent of output. We can think about the cost of making the next one, which would be its marginal cost, and we can go back and forth about average fixed cost and all these different things that we might think about. But one way that we're going to divide them up, and the essential way for this particular kind of material here, is to divide them up based on whether they're explicit or implicit costs. So you ask yourself when you're thinking about a cost or a sacrifice that the firm makes in order to produce, is that an expenditure cost? Did they have to pay someone else to use some of their resources? Or was it something like they owned some resources and could have used those in a different way to gain something? And so then we would think of the cost as more a sacrifice of potential gain. Does the firm have to write a check for that cost? If so, it's an explicit cost. If not, probably you're thinking about implicit costs. So now let's put on two different types of lenses, and we'll want to contrast these throughout the rest of the video. So first is I want you to think from the point of view of an accountant, and we'll think about accounting costs. Really, accounting costs would be kind of like if you were balancing the firm's bank account or checkbook. So you would sort of say, what did it have to spend? Well, those are only the expenditure costs. So accounting costs are explicit costs, expenditures the firm makes for use of resources that it does not own. When we think more broadly, economists would say, well, you're ignoring a huge chunk of the costs. There are also implicit costs, sacrifices that the firm or the firm owner has to make. They're gains that person could not accrue because they've chosen to produce this product. If I quit my teaching job in order to open up a pizzeria, then my teaching salary is probably the biggest and most obvious component of my implicit costs. I'm not paying anybody the value of my teaching salary. but it is something I had to give up in order to, realize my dream of running a pizzeria. So what the entrepreneur might earn selling her labor somewhere rather than working for herself, that's a big part of implicit cost, but sometimes it includes other things too, that, and we'll get into examples of that, other resources that the firm's owner owns themselves, doesn't have to pay to use, but they can't use it for some other purpose which would have given them a gain. If this was a little long and a lot of words on this slide, then here's the fundamental lesson at the bottom of the page here. Economic cost is bigger than accounting cost by the amount of implicit cost. Accountants see explicit cost only. Economists see explicit and implicit cost. All right, so let's now think about profit. And the good news here is that everybody agrees on the fundamental definition of profit, which is that it's revenue minus cost. We use these colors to sort of help us visualize as we move through the next couple slides. And here's the unfortunate part. We defined cost differently, so we're going to start with the same number, and an economist is going to subtract what they think of as cost and get economic profit. An accountant is going to subtract what they think of cost and get accounting profit. So accountants and economists don't end up at the same value because they view cost differently. Now here's a couple things. When we talk about maximizing profit, don't think that means you're earning a positive economic profit. There might be none. There might be no profit at all. The idea is we're just trying to find the level at which it's highest. So in some cases, maximizing profit means minimizing a loss, because perhaps producing any other quantity would be a bigger loss. Okay, so now some just basic core definitions here. Economic profit is total revenue minus economic cost. Well, what's economic cost? That's implicit and explicit. Accounting profit is total revenue minus accounting costs. Well, those were only explicit costs. So accountants have a smaller view of cost, so they're going to end up with a little more profit because they subtracted a smaller number. They start with the same one, subtract a smaller number. Economists are subtracting a bigger number, start with the same one, subtract a bigger number, you end up with less. So accounting profit is larger than economic profit by exactly the amount of implicit costs. And in a moment, you'll see why this difference, or this concept, this value of implicit costs, it can also be referred to as normal profit. All right, graphical interpretation here. We have that same total revenue box that we had a couple slides ago where we had price times quantity. Maybe I made t-shirts and I made 20 t-shirts and sold them for $10 a piece, and there's my $200 of total revenue. And so I'm bringing that box up here. And now I want to think about how that revenue might shake out. Maybe here were the amount I paid for the silk screening to be done, and here's the amount that I paid for the cotton t-shirts and all those sort of things. Okay, there we go. And we take that total revenue, we subtract out the cost, we see how much revenue is bigger. You can tell it's bigger than cost, and so the accountant would say, well, here's how much profit you earned. Okay, cool. And they're probably doing that with the motive of saying, here's how much you made in your business, and here's how much you will have to report to the IRS and pay taxes on, something like that. The economist will say, whoa, 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 hold on a minute now. You just used this first floor office building space that you own to print t-shirts, and instead you could have rented it out, perhaps. Well, I think maybe you're underestimating your costs, because your costs are what you paid for the cotton and the silk screening machine and so forth, but you're not thinking about the rent you could have earned if you rented this out. They're going to say that there were some of those implicit costs, and they'll sort of say, hey, you accountants, you kind of discounted these. You didn't think about these, and so profit in your mind was bigger than we think it's actually going to be. You can see here that the implicit cost is viewed as part of profit from an accountant point of view, and it's viewed as part of cost from an economist's point of view. The economist is going to say, really, what you earned as economic profit is represented by this box here. It's much smaller. You can see the economic profit is smaller than accounting profit by exactly the amount of implicit cost. So let's put that into practice here with an example. Maybe you've thought about at some point driving for Lyft or Uber. Would you be able to earn a profit? What would your costs be, right? So let's start using an example here. We'll imagine Serena decides to drive for Uber. She sort of had a job where she was maybe earning $10 an hour perhaps, and she decided to quit that job because now she would have more flexibility, and she's going to be disciplined in the sense that she's going to work just as hard and for just as many hours as she used to at her job. So there's no change in the amount of leisure time maybe. So let's think about this. She made 100 trips in a week and she earned $10 per trip. Hopefully, you've identified that this is like price and this is like quantity, and her total revenue would be $1,000. Great. Okay. What were her costs? Well, she spent $400 in gas that week, and she paid $60 to have her car cleaned and $40 to have the oil changed. Right? So there we go. $400, $500 worth of cost. Okay? All right? So maybe the accountant here is saying, here's our $1,000, there's $500 of cost, and then there's $500 worth of profit. Boom. Okay. The economist might say, well, hold on a second. You would have earned some money at your other job. And if we take off what your wages would have been at your other job, maybe now your profit is only this big. Perhaps Serena would have earned $400 at her other job, but she had to quit that job. And so her economic profit is really only 100, not 500, as the accountant saw. That's pretty extreme numbers, and they don't correlate with the size of the boxes, but hopefully that makes sense. Now, did she earn profit? Yes, by both the economic and the accounting standard. Was it wise for her to switch? In this case, yes, it was, for sure. She actually earned more profit than she could have earned in wages from her other job. Right? Her economic profit was bigger than normal, right? Okay. Would you want to enter this industry under these circumstances? If you had the same job Serena had, then you would, okay? And then we would see that, and it's because of the positive economic profit, this blue box up here, we would see that people would want to enter into that industry. Okay. Now let's change the world a little bit. Here's our total revenue box. It's exactly the same size. Here's our accounting cost box. It's exactly the same size. Here's our accounting profit box. It's exactly the same size. Here is our economic cost box. Boom. Well, you'll notice it's bigger. Why is that? Okay. Well, it can't be because of accounting costs, right? Those are still the same size. And what must it be? Well, maybe Serena underestimated those implicit costs. Maybe there's some implicit costs we haven't discussed. And in fact, this is a real thing for people that drive for Lyft and Uber, is that oftentimes they underestimate what those implicit costs are. In this situation, you can tell economic cost is bigger than total revenue, so there is an economic loss. And this is a weird thing, right? The accountant thinks there's profit. The economist says, no, 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 there's loss. So now let's kind of make that a reality here and think about what happened. Well, what are her implicit costs? Before we talked about the $400 of earnings she could have had at her job. So, sure, but if that's the case, then she was making a $100 economic profit. But she's doing a lot more wear and tear on her tires, and she's going to need new tires a lot sooner than she otherwise would have, and that was an implicit cost she underestimated. Also, her car, because she's putting miles on it, it is losing value way faster than it otherwise would have. And I think there's some studies that I've read about with a couple of colleague teachers that show that maybe it's as much as $300 or $400 a month that Uber drivers sometimes cause wear and tear on their car. So the value of it when they want to trade it in or sell it is way, way lower than it otherwise would have been. And that's a cost that's easy to ignore. Okay? All right. What's going on here? In the first example, her accounting profit was positive, and it was higher than it would have been if she had kept her job. It was almost like she was earning extra bonus profit, or what we're going to say is more than the normal level of profit. We'll define that as what she could have earned doing something else. She was earning more than her implicit costs. Her economic profit was positive. In that situation, we envied Serena and we wanted to join the industry. We would predict people would quit those $10 an hour jobs in order to go into this market. In the second example, though, you would not have wanted to follow her lead because she was earning a negative economic profit. Yes, she had more revenue than explicit cost, but she was behind where she would have been if she had taken another course of action. And so as a result, when there's a chance for her to get out of the Uber driving situation, she's going to look for that exit lane and maybe go back to a job that pays her $10 an hour. Her accounting profit was positive, but it was not big enough for her implicit costs. It was less than normal profit. The idea here is that economic profit is bigger than accounting profit by the amount of normal profit. Normal profit is our implicit cost amount. That non-expenditure cost, depreciation on her car, and the value of her salary that she was giving up, and the wear and tear on her tires, all of those things, the economists will say those are real costs, and the accountants are not calculating them properly, and so therefore they're going to end up with a bigger value for profit than what we really think there is. So the big idea is that economic profit, whether it's positive or negative or zero, is a very clear predictor of future action. In the second example, you would predict Serena would leave the industry. In the first example, you'd predict other people would follow her in. So we like to think about economic profit rather than accounting profit because just knowing the sign of it, positive, negative, or zero, tells us whether there will be net movement into or out of an industry. One reminder that when you think about cost curves and graphs and you look for boxes of total revenue and total cost and things, the total cost box and the average total cost curve that we draw, those are always including the implicit cost as part of fixed cost usually. So when you see that there is no profit or loss box on a graph, that means there's no economic profit or loss. And that, of course, would mean that accounting profit would be positive and exactly equal to normal profit. Hopefully that has helped you a little bit. Thanks for watching TCon. Please feel free to leave a substantive comment in the comments and like and subscribe if you're interested in learning more economics by videocast.